Hello. Good afternoon, everybody. Welcome to the AlphaWatch video series. I'm super excited. Today, I got two good buddies, Tim Rudderow and Dave Aspell from our great partners at Mount Lucas. Gentlemen, how goes it today?
Good, John.
Well, you're not as good as me because I'm in Omaha, Nebraska, where the sun always shines. But you can come and visit whenever you want. That's for sure. So I want to start off lots of questions coming up. Every call I'm on, people are saying, what's the future for commodities? So I went over to our good old government resources, look things up. The EIA drawdown after Labor Day was 6 million barrels, 8.4 million barrels drawn out of the strategic petroleum reserve. That means a build of 2.4 million barrels. That's the largest weekly drawdown in the history of the SPR, the most ever to come out in 1 week. Same time the White House comes out and says, well, maybe when the floor hits $80, we're going to go out and buy it. I don't think the traders are going to let it get to 80. Right now, it's at $85 per barrel. What's going on with oil? Can you guys prognosticate or at least give us an update? These commodity markets are silly, and I don't think oil is going to stay low for very long. I have a feeling it's going up. What say you?
Well, let's start. We believe that the situation in oil is the definition of transitory, because as you pointed out, they've reduced the strategic petroleum reserve that has tamped down prices. That in combination with the COVID lockdowns in China have decreased world demand, but global visible stockpiles are near all-time lows still. And what's interesting is this same phenomenon goes across many commodity markets where we have a relatively soft patch in demand right here, mainly China-driven, which we think will collide in the future with looming shortages across the commodity space. So when and what will drive that? Dave will talk about the Fed a little bit, but the China pivot out of COVID lockdown, which might happen around November with their big leadership meeting, who knows, right? But there are going to be some pretty easy signals to say this pivot's going to happen. But we see this same thing across the commodity space. The Wall Street Journal today had an article about the shortages of butter. It's the craziest thing. So it's going to be across the space. Let me give you another example outside the crude oil area. Live cattle, beef prices are the one place that over the last year prices haven't gone up all that much, only 2.8%. Why is that? Farmers have been culling the herd. And when they sell down the herd, it takes about 36 months to build the herd back up again. If we come back out the other side of this, Fed takes their foot off the brake, China comes back. If those two things happen together, we could see a big run in commodity prices in the coming years. Dave, talk a little bit about what's going on in the Fed and how rates might affect this.
Yeah, what we see going on is that, obviously inflation has been fairly high, wages are fairly high, and housing has been, was fairly high coming out of lockdown. So what the Fed's trying to do is it's trying to increase interest rates quickly to get on top of that. And the way we see it is what they're doing is the housing inflation that you've had, you've already had rate rises that have done enough to slow down housing. You've seen big drops in new home sales. You've seen prices start to roll over, but that's not in the CPI numbers yet. The inflation, the way that the Fed sees inflation, because it takes a while for that to filter on through. So what we're thinking is that you've had a lot of the slowing is already coming from the Fed. What the Fed's already done, that monetary policy operates with long and variable lags, and it takes a while. And all it's going to take is the Fed to see that, for shelter inflation to come down a bit, which will happen naturally. And then as that happens, the Fed no longer needs to be quite as aggressive and doesn't need to continue hiking quite as aggressively, which then supports demand for a lot of things across the commodity space and across global demand, because as the Fed is hiking rates, that's pushing up the dollar against emerging markets, which is hurting them. So all you need is for some of these things some time to pass to calm down, and then you can see the other side of this panic.
Yeah. No. Oh, you brought up a word I want to talk about. You said dollar. I know you have other currencies in your back pocket, Dave Aspell. You carry around wherever you go, you foreigner, But the DXY is at 109, almost 110. And I was looking at doing some just simple numbers. SPY, revenue of the S&P 500 outside the U.S. is about 60%. This is scary stuff to me. So what is the strength of the dollar? Obviously, it's a relative strength, but we're at 1.9, 1.10, dollar milkshake theory coming through. Like, what's that going to do to the S&P 500? Is it a drag? What does it mean for commodities, not just oil, but grains, like you said, and metals? Like, can you guys riff a little bit or give us some? Don't scare me to death here. I'm an optimist. I'm a Nebraskan, but geez Louise, that sounds a little scary to me.
Yeah, he's already ruining baking season with his butter shortages and putting, we can have much more fear put into it. The dollar. I mean, what's going on in the dollar is, the US pumped in an awful lot of stimulus into the economy and is now coming out of the pandemic particularly strongly, particularly relative to other places. And you've got a world in which the Fed is hiking rates by 75 basis points per meeting, and you've even got the ECB, starting to hike interest rates, but also in quite large amounts. And you've got places like Japan, where they're trying to keep their 10-year bond underneath 25 basis points. So when you've got the Fed hiking by 75 basis points, every 6 weeks, and Japan trying to keep their 10-year under 25 basis points, that just puts an enormous amount of pressure on currencies like dollar yen. And we've seen that.
I mean, we saw that this morning. We saw the Bank of Japan intervened in the dollar for the first time since 1998.
Yeah.
So I mean, they're obviously showing a bit of panic there about what's going on in the yen relative to the dollar, and they got a pretty big move initially, but it kind of sold off through the day. I mean, the dollar was slightly weaker against the yen, but nowhere near where it was at the high of the day. So yeah, the dollar trade is enforced, but that again, things could turn around relatively quickly if the Fed takes their foot off the brake.
Do you see that impacting the S&P, the major stocks we see out there? How big of a drag is this? And is this something that takes a while to unwind? Does it move quickly as it impacts some of these big companies?
One of the hardest things to interpret, because you don't know how they're hedged.
Gotcha. It all depends on that.
You just don't know how they're hedged.
Gotcha.
So, yeah, I mean, it'll filter through the earnings. And I mean, I don't know about you, Dave, but I haven't read a lot of reports that the dollar is killing people here. So, I mean, it might be a part of things, but people who run these businesses are pretty sophisticated. So, I mean,
you would think
they're going to be thinking about this.
Well, you brought up another word, that hedge word. So now that I got you here and I've, softened you up with some easy ones, help me explain to my dad what on earth managed futures are and why you invest in them. Make it make sense, Tim. Make it make sense, Dave. Managed futures. I want to sound like I know what I'm talking about, even though I'm just a dumb Nebraskan. Help me.
Businesses have price risk. The futures markets exist to allow businesses to move that price risk to somebody else. People get paid to hold risk. This is another kind of risk. Managed futures is holding the price risk of businesses. It has a risk premium that's similar to other risky assets with similar levels of volatility. Simple.
Dave, let's test you. Let's test your acumen.
Sure.
Make it make sense.
Okay, well, you're in the great state of Nebraska. That's one of the grain sort of producing regions of the country, right? And what you have, one reason this exists is that if you're a farmer, what you're really exposed to is the price of whatever you're going to sell your grain for at the end of the next harvest season, which might be a year away or 6-9 months away. But you need to start planning your costs right now. And it'd be really useful if you're a farmer to be able to know exactly what you're going to get for that corn or soybeans or wheat in 9 months' time. And what futures markets allow you to do is to do exactly that. You can sell that crop forward, which then takes out all of the price risk from a farmer, which is really valuable. And they can concentrate on the things that they're good at, which is, growing grain and running a farm. And it works the other way as well. That if you're in the business of buying large amounts of grain, if you're a baker, or maybe in Tim's butter example from earlier, if you're a consumer of things like grains and wheat, it's really, really useful for you to be able to know exactly what you're going to be paying in the future for your for the inputs that you need, whether that's oil or grains or sugar. You can lock in the supply that you need at a price, which means that you can then go about running your business and making whatever it is you do with a product. And that risk transfer function is fabulous. It really helps the economy move along. It takes out uncertainty from people that just don't want that uncertainty. That farmers don't want to be in the business of speculating on grain, and Starbucks doesn't want to be in the business of speculating in coffee. It's just not what they do. What they do is they run nice places for people to go and talk to their neighbors. They don't want to be worried about what sugar prices or coffee prices are doing. So what it does, it allows that risk transfer so everyone can go about doing what they're good at. And that risk premium gets earned by people that step into the middle of it and take on that risk. And it's a premium that moves generally with volatility. People are prepared to pay more when things are volatile. And when things are volatile in the broader world, that's often what hurts stock markets. And when stock markets are getting hurt, it's good to have some exposure to something that does well in times of volatility, because they pair up nicely.
Yeah. All right, I'm going to try it out in my...
Here's an easy way to remember it, John.
Okay.
When the fertilizer hits the ventilator, managed futures does well.
No, I'm going to use that analogy with my mother, and I'll try the explanation with my father.
Okay.
My one big takeaway, though, is I'm going to Costco and Sam's Club, and there's going to be no butter left in Nebraska. It's going to be the currency of the future. Forget gold, silver, and cigarettes. It's going to be butter. All right, so we always like to end with the AlphaWatch windup. I'm going to give Tim the last word. Tim, you got 30 seconds. We're on the elevator on the way to the 10th floor of the tallest building in Nebraska. Explain, what do I need to know about commodities, currencies, or futures? Ready, go.
Sometime in the next couple of years, the reopening of China and the general supply shortages that we're confronting right now will lead to a next pretty big leg up in the commodity markets, and we should be prepared for that.
Good. I like it. Good. All commodities. Well, hey, you guys are the best. Thank you for taking some time. Learned a lot about crude oil, commodities in general, butter. Good night. The dollar at strength, and then what's futures? We're transferring risk. I like it. The ventilator analogy is a good one. Hey, you guys, thank you so much for jumping on short notice. We'll talk to you again soon. Everybody else, make sure you subscribe and keep joining the conversation here at AlphaWatch. Have an awesome day. We'll talk to you guys soon. Thanks.
Bye, John.
See ya.